just on this pullback, based on a break of structure of this pullback. So all of these little structure points being broken are not going to throw me off. And not only that, my trading becomes a lot less stress-free, because when I start to observe this type of trend over here, all I need to do is set my alert. Once the market breaks the structure point and my alert goes off, that is when I would look at the chart and I'll start to pay very close attention to what has actually taken place over here within that break of structure and start to look at my points of interest within that range. The reason why we do this, some of you now might be confused because you might think to yourself, hang on a second, over here, you're still looking left to find your point of interest. You still might have that issue of, am I going based on this institutional candle or this institutional candle? But what you need to understand is we are limiting the amount of information we are analyzing. We have gone potentially from, let's say, a 200 pip swing to maybe a 50 or 100 pip swing. It's a lot more limited, the area that we are looking at. And if we continue to do this going lower and lower and lower, you'll end up looking at very small risks. So it doesn't really matter which institutional candle you take the trade based on. And not only that, within these scenarios, you will find that your entries are a little bit less confusing, as you are simply looking for the area that sponsored this break of structure. I'll say that one more time, not going to elaborate too much on it right now, but you simply would want to find the area that sponsored the break of structure. Quickly, I want to cover this from a supply and demand perspective as well, just so it makes a little bit more sense why this actually takes place and why I use this as one of the confirmations. Something important to understand is just because you can't identify an accumulation or a distribution doesn't necessarily mean it doesn't exist. For this market to turn around and go up, it must have accumulated down there, even if you can't see it. For this to reverse and come back down, it must have distributed up there, even if you can't see it. Which means when I'm looking at this trend and I'm waiting for
I'm going to change you
and be able to take the trade,
I'm going to clean you up.
That's up here, we have an area of distribution. That's where supply was introduced to the market, pushing this back down. Now, if this supply is sufficient enough, this is going to start to break lower and lower and lower. The trend would normally start to be respected properly. You will start to get more aggressive and longer swings to the downside and would end up breaking the major structure points to the downside. But now we want to use the same analogy to see if it's a lot less likely to break lower and a lot more likely for it to reverse and go back up. And the idea behind it is on the lower time frames, all of these areas can count as minor supply, minor supply. All of these can indeed count as minor supply. The same way down here is now a demand area, an area of accumulation where this has reversed. These are all minor supplies up there. So once the market starts to challenge these structure points, that means it has now completely violated that area of supply. And if it does the first one, it might be likely to continue to violate the next areas of supply as well. These are normally when I would pay attention to accumulations that would take place over here, to the type of price action that we would get as this market is reversing and breaking structure to the upside, to kind of make sure that we do have strong elements of demand. Indeed, we have introduced a lot of positions in the market. Again, you can start to see these by the strength of the move. And by that, I mean how quickly we've moved away from a specific level, and you can also see these by breaks of minor or major structure points. Never thought I would be using this documentation or this screenshots, especially because it was taken quite some time ago, but I guess this actually kind of applies in this specific situation right now in terms of that supply and demand that we were talking about a little bit earlier. There's not much information on this chart. This was a quick documentation for myself just to see this previous areas of demand on GBPUSD from end of last year, and that was when I wanted to see if GBPUSD does have the likelihood of having another massive leg to the upside, or whether this is going to be the complete reversal for GBPUSD. So similar to what we spoke about before, this was our little counter trend market under retracement from the high to the low. So that's our high over there, low, lower high, lower low. This broke that structure to the upside, created a new structure point in the market. So now we have kind of that directional confirmation. And something that was really interesting to see over here on the FXCM data feed was this range down here that was created, because there was a few factors that kind of added together. Number one, this move to the downside was a manipulation of a lot of previous lows. So it definitely tapped into a pool of liquidity, which in itself can qualify as a zone of demand or supply. Number two, it moved away from that level extremely quickly. We actually gapped over the weekend when it moved away from that level. So there must have been a significant amount of demand introduced down here. And not only that, it did indeed create a new structural high in the market. So this entire move, this entire rally was sponsored by whatever took place down there. It's not always the ultimate bottoms and ultimate tops that would sponsor the major move, but in this case it was. So that level down there is now going to qualify as an area of demand. We've manipulated previous lows, it's moved away from that level, it's created a new structure point, blah, blah, blah. So I shouldn't be surprised to see the market now back in this level, getting ready for the next rally to the upside. And looking at GBPUSD, this was this exact scenario over here. So that was that gap, this was the level. This wasn't necessarily something that I traded, it was more so something that I wanted to see if this is going to, in a way, sponsor the next massive rally for GBPUSD, which it did. That was indeed the beginning of a huge move to the upside. It might not have necessarily been sponsored by the final push to the downside over there. We did have some other reaccumulations, which I'll speak about a little bit later. But either way, we did have a final push to the upside. And this is that picture which we saw earlier as well, the yellow circles being your major structure points. And we can see as this low was being created, we had this counter trend market. It manipulated lows, it broke the structure to the upside. So later on upon this pullback, we could have looked for entries. Let's have a look at a few more scenarios, analyzing it from this perspective as well. Another textbook example is this low over here for GBPUSD. Generally speaking, the major structure points would be that low over there, this high, and then potentially this higher low over here. This was also a move that in a way challenged some previous major structure points. So we did have an idea that potentially this could be the beginning of a bullish move, but I still want to now see those bullish confirmations, those final directional confirmations. So upon this retracement over here, I can start to look at some structure points on the lower time frames. I don't necessarily need to go to the 15-minute time frame to be able to identify the major structure points here. I know that that's a high, that's a lower high. This is another valid lower high, another valid lower high, and another valid lower high. So generally my trend is looking something like this on the lower time frames, which means this is now this lower time frame pullback. This is now this lower time frame retracement, which upon a break above this, I can actually have my final directional confirmation. And that indeed is what we could have traded based on. A break above this level would have confirmed that structure is now on your side. You're bullish on the higher time frames, and upon this lower time frame pullback, you have now broken the structure in your desired direction. So look for entries. Funnily enough, structure at this point would have been more than enough to give us enough directional confirmations. However, it wasn't only structure. This is where you can mix everything else that you have learned from other videos or have learned from other courses perhaps. But again, this was a very textbook example. We've spoken about this many times before as well, because this was a manipulation of a trend line to the downside. And as it was doing that, as it was manipulating the trend line and to sponsor this move to the upside and a break of structure to the upside, we actually had an entire accumulation range. So now we have multiple different confirmations pointing towards the same thing. So we go ahead and look for entries. Also, you might think to yourself that I'm not talking too much about entries right now. That's because I'm saving that for this case study or for this quick trade analysis that we are going to go through together in literally a couple minutes. Before doing that, however, let's look at a quick final couple examples. This would be a nice move to cover from the same level that we were looking at just before. See the yellow circles, the major bigger trend, and you can see the smaller trend marked in blue, and the retracement is what I care about over here, marked in pink. So remember, I'm not too keen in trying to figure out whether it's going to bounce up here or whether it's going to bounce up here or whether it's going to come down to this imbalance and institutional candle. Quite frankly, I actually don't care where it's going to bounce up from, because either way, I just want to take the trade. It makes no difference to my life whether I'm in the trade at this level, or at this level. I know I want to capitalize off of this currency pair. I just want to have my confirmation. So I'm not going to waste my time trying to find a lot of entry points within this region. I pay attention to the structure upon this pullback over here. And this is an interesting structure. Some of you might just consider that a three-way structure. Either way, it doesn't matter. It's the same thing. But now we have structure points that I can go based on. What do? We identify the last major structure point. And upon a break above that, we have now confirmed our direction. So this was an example that it didn't actually violate the previous trend. It simply stayed respectful of the other trend, created a minor counter trend upon this pullback, and a break above there was what confirmed the trade. So when it started to trade above there, now start to have a look at entry, start to have a look at where we want to actually execute the trade. And again, it's quite interesting and entertaining to kind of see this picture repeat itself over and over and over again and give you a lot of different example, once we had the confirmation of the structure on our side, this market almost instantly, not exactly instantly, but within a short space of time, it went into an entire reaccumulation phase. So for those of you that might find it difficult to look at structure, you would have caught it based on Wyckoff. For those of you who would have found it difficult to look at Wyckoff, you could have caught the same trade using structure. There's a lot of different things and a lot of different ways that you would be able to actually approach this, a lot of different confirmations that it gives you. And surprise, surprise, similar to what we spoke about before, similar to what you saw before, if you're meant to be going in a given direction for a specific or for a long period of time, you should continue to get confirmations of the market moving in that direction. Meaning if I should be expecting the next rally to the upside, exactly what took place, I would need to see elements of manipulation to the downside. Why do we need to see manipulations to the downside? Why do we need to see these lows or these trend lines being taken? Because that's where demand is being introduced to the market. That's where the liquidity is being taken, meaning a lot of people, a lot of institutions around the world are being taken out of their trades, which naturally releases more money in the financial market, allowing the bigger players to open larger positions, which would make the areas of demand and supply a lot more valid. So I really do hope that this little nugget made sense, especially for you to know that you don't necessarily need to worry too much about your points of interest, and instead you can focus on the structure being on your right side and continue to move to the lower time frames doing that. And once you have your final directional confirmations, then you would be able to figure out where the major move was sponsored by and take your trades based on those levels. Now let's put all of this together and break down a trading scenario. But before I do that, I need to mention that this is actually an intraday scenario. So I always speak about what a swing trader I am and how, you know, the positions that I take are more so on the longer term side. The positions normally I stay in for maybe even a few weeks. I still have positions open from beginning of this year practically. But this specific trade was very different to the normal trade that I would take. Number one, because it was an intraday scenario. Number two, because it was Friday. Normally when I want to, you know, take swing trades, I don't necessarily like to execute them on a Friday, but everything was lining up for this specific currency pair. So I did indeed decide to enter myself into intraday scenarios, and not just intraday, this was actually a counter trend scenario as well. But I want to kind of go into information as to why this trade was taken and what was the analogy behind it, and why did I even decide to go bearish in a bullish market, going against everything that I have kind of said and taught. But hopefully this will actually clear up a lot of things about how we can counter trend trade and how you can take advantage of all of the moves. So I can trade this to the upside and trade it back down, if that makes sense. And more importantly, how to hedge. And this would be specifically hedge scenarios as well. Funnily enough, these didn't start off as intraday scenarios. I didn't actually take these trades with the intention of having an intraday scenario, or at least a short term, just over the weekend type of scenario. I started these sells with the intention of hedging, with the intention of I want to sell this to later on look to buy it, but the buy confirmations never took place last week. Perhaps next week we'll get it. Whenever I get it, I'll take the trade. So since this is an intraday scenario, we're not necessarily going to be focusing too much on the higher time frames like daily, weekly, monthly. Even 4 hour in this case wasn't necessarily relevant. This analysis was mostly on the hourly and below. However, funnily enough, we did have the higher time frame confirmation. So on the higher time frame, such as 3-day time frame, we did tap off a previous area of supply, a previous institutional candle at the top over here. So this indeed could have, you know, sponsored certain moves back down. This could have sponsored a deeper retracement on the higher time frame for GBPUSD, something that kind of we've been expecting a little while. So although the analysis wasn't based on the higher time frames, we did have some higher time frame confirmation as well. On the bigger picture, there's definitely a few things that I cannot ignore and I have to pay close attention to, because they could indeed make all the difference between the correct or the incorrect trade. It seems as though this final impulse that we have had to the upside on the hourly time frame, on the 4 hour, this is going to look very different. The impulse would start a lot lower, but at least on the hourly time frame, it kind of looks like the major impulse started from down here. This was the ultimate low that was created, and from there we've been trading above that level and continuously going higher than that level as well. So that was the most major low that was created. That was the first element of demand that we had over here. This is now proof of demand over here. So this in a way is where I can see that that demand is now being proven to me. Yes, okay, this is valid as a demand. We've moved away from that level. And it looks as though this entire range can be classified as a reaccumulation range. And this was interesting to see, because in a way, this is a simple rally-based rally formation on the higher time frames. I know a lot of you trade supply and demand based on your rally-based rally or drop-based drop formations. Practically on the lower time frames, this is a redistribution and this is a reaccumulation. But you know, in these contexts, reaccumulation, redistribution, rally-based rally, drop-based drop, institutional candles, doji candles in the middle of range, all of these things are identical. They are all pointing towards the same thing. So whichever one of these concepts you've been trading, you're definitely doing the right thing. As one of my good friends once explained, it's the same car crash from multiple different angles. But either way, this reaccumulation over here was quite interesting because it looks as though it was actually this reaccumulation that sponsored the final move to the upside. It wasn't necessarily the demand down here. It could have been, but I'm not necessarily going to take into account this demand all the way down here. First, I want to take into account this hourly picture, this hourly structure, this hourly push to the upside for multiple different reasons. And we did speak about some of these, such as manipulation of the lows, a break of structure to the upside, and the market moving away impulsively to the other direction. So now my attention is a little bit more towards this final hourly impulse. Why? Because this seems to be the more attractive one. And I know I'm in a bullish market. So I know that the higher time frame is still bullish. So I'm not actually right now looking for sells. I'm actually looking for buy scenarios. And when I look at this final hourly impulse, this is where the problem begins, right? Because you can see imbalance over here. You can see maybe another unmitigated or an imbalance down here. You can see another imbalance over here. You can see it's another imbalance and unmitigated institutional candles down here. You now have 4 different points of interest that you can potentially buy this based on. And it becomes scary and it becomes difficult. You might not necessarily want to take 3 losses before you take the real trade. To avoid all of this confusion, now I'm not necessarily paying attention to these imbalances and to these institutional candles and to these points of interest. I don't really care about that just yet. First, I want to see my directional confirmation, meaning what? When I'm getting this pullback over here, first, I want to see a break of structure to the upside. I first want to know for a fact that this is the bottom of that pullback and this is indeed going to reverse from there. So naturally, that's exactly what I will be waiting for there. And then I'll probably be monitoring the 15-minute time frame in this case to be able to see the pullback a little bit easier. But most definitely this pullback over here would be what would draw my attention to it, would be what interests me to be able to later on potentially find entry points based on it. Now, for those of you who might still be confused what we mean about a hedge scenario and why we would want to hedge and what hedging generally is, the idea of a hedge is when you buy and sell the same asset at the same time, where it doesn't necessarily mean you would execute a buy position and sell position at the same time, but when at one given time, you're both in a buy scenario and a sell scenario for the same currency pair, for the same asset class that you're trading. And you know, for some people, this makes sense. For some people, it doesn't. Some people think hedging is a good idea to kind of protect your losses. Other people believe hedging is actually worse because you're taking more risk on your account and blah, blah, blah. I don't want to give any more attention to opinions. I'm here to talk facts. And the fact is, if you know how to hedge correctly, you will most definitely decrease your risk because you will cover the risk that you're about to take before you even execute the trade. And this is the idea behind it. If I generally know I need to be buying GBPUSD, right? In the sense that I know generally I want to be on the bullish side. I just want to see my confirmations. My technical confirmations are not there, so I can't buy it just yet. We still haven't broken structure just yet. But if I generally know I want to buy it, wouldn't it make sense for me to try and get in some type of a sell position a little bit higher, sell it down to my point of interest, and when it hits my point of interest for the buy scenarios, I wouldn't close these sell positions. I would keep them open. I would make them risk-free. I'd break them even, but I would go ahead and buy it there and then. So in a way, when I look at my MetaTrader 4, I'm in one sell position that's healthy in profit, and I just bought the same currency pair with the same percentage risk. There's only a few scenarios that can now take place over here. Number one, the market will go in my direction on the bullish side, which would mean the sell scenarios would be taken out at break even, and I will make money on the buy scenarios over here. Amazing. The other scenario that can take place is this market going the other way. So the buy scenarios are now wrong. The buy scenarios have hit stop loss, but the sell scenarios are still open. I haven't closed them, remember? I might have taken a little partial, but they're still open, which means as this market is going the opposite way and hitting the stop loss on that trade, the money that I'll make on these sell positions would automatically cover my losses majority of the times. But this has to be an extremely calculated move because done correctly, you're actually managing your risk properly in the sense that I'm covering the risk that I'm taking before I even take it. In a way, I'm about to enter myself into more or less a risk-free scenario. But if not done correctly, what that would result into is one loss over here on the sell scenario and one loss on the buy scenario. So instead of perhaps one win that would cover everything, I would give you a lot of money, you would actually end up with two losses, especially because when it comes to hedge scenarios, the first position oftentimes, if not all the time, is going to be a counter trend scenario. So obviously the sells that we would want to be taking back down over here, this is now going against the bigger picture, the bigger trend, the bigger structure. So we most definitely need to see some very, very, very valid confirmations. Now, going back on the 15-minute time frame, I know what I'm expecting. I know what I'm waiting for. And I'll put this in replay mode as well to kind of show exactly where I started to see this. It was somewhere around here. We've got this screenshot over here. I'll show this to you guys before I start to speak about the currency pair taken on March the 9th. Currently it's 20th of March, so this was just under 2 weeks ago. And that was kind of the general idea behind it. That was our hourly and the 15-minute range of supply that was identified. And I just wanted to see proof of supply. I just want to see that that area up there is still valid. It's still going to prove as supply to us. So that's generally around that 1.4 region, kind of the reaction that we expected to see. Now, going back on the charts, yeah, that's give or take roughly around the same area, so we can have a quick look at it. When I was seeing this counter trend market coming back down, one obvious scenario that I was waiting for would have been a break of this structure point to the upside. So, obviously a break of that structure point to the upside would have been the beginning of potentially this bullish move. More so, a break of this structure point would have confirmed the bullish side. The reason I said the higher one is obviously because even at this stage, this did have the possibility of doing this. It wasn't a very big possibility. This wasn't a scenario that I would have wanted to see happen there and then. At least, it's a scenario that maybe later on, even next week, might come to fruition. So it might end up climbing a little bit higher to close this imbalance before the next leg down, if it is going to go down. But that was, one of the more obvious scenarios that I was waiting for. In a way, for me to buy this, I would have needed to see a break of structure to the upside. If I didn't see that break of structure to the upside, there would have been no point me looking at buys, right? There's no reason me keep analyzing this over and over again. Now I kind of want to see if I can hedge myself into those buys, if I can find a sell position. Again, looking at the markets from a factual way, not from an emotional standpoint. And looking at this from that perspective on the 15-minute time frame, it's kind of easy for me to go ahead and identify that as high, and lower high. Maybe the next lower high is about to be formed, but from that high, we created the low, lower high, lower low. I didn't consider this one as the next lower high, and the reason behind that is because we didn't really get a substantial retracement after that. The major retracement was what took place after this low, and it is quite interesting as to what took place after this low, because we had elements of clear supply being introduced in the market through, number one, manipulation of the highs. That's what took place over there. So as you can see, indeed, it did manipulate these previous highs that were being created within this range. And more importantly, it actually turned into a redistribution or a smaller distribution phase in the market. I just want to remind you how similar this situation is to what we spoke about before, where within this bearish trend, although yes, it's a smaller time frame bearish trend, but on this time frame, within this market structure that's bearish, for this to remain bearish, we need to have supply and manipulations of the highs. The same way for the market to remain bullish, we need to have demand or accumulation and manipulation of the lows. This is the exact opposite, and we are indeed receiving that. We're getting supply through distribution. And as it's creating that distribution, indeed, it is manipulating some previous highs as well. That's one of the reasons I took this high as a major structure point, especially once it created a new low. I would normally want a deeper retracement, a little bit something more substantial to consider that as the major next lower high. But in this case, everything qualified. We did have a new structure point. It was indeed a manipulation of the previous highs. Not that it always needs to be, but that was an extra confirmation. And we moved so quickly and fast away from that level, breaking some of these previous structure points to the downside as well. Now, this is kind of putting a little smile on my face as I'm analyzing it, simply because it's getting ready for those potential hedge scenarios that I was waiting for. The sell scenarios that I would have wanted to take to then later on look to buy it now look a lot more confirmed. Now they look a lot cleaner, simply because there is a whole distribution range over here, and this entire range is actually a redistribution range, but I'll leave that to you guys to go and mark up and study on your own. But now I have got the confirmations that I would want to see. I just want to see my final directional confirmation. The same way in the bullish trend, you would have wanted to see, or I would have wanted to see upon this little pullback over here, I would have wanted to see a break of structure to the upside and then look to trade it. In a bearish trend, as you can imagine, it's going to be just the opposite of that, right? So within the bearish trend, as it's coming down, obviously these little retracements to the upside are going to look like this on the lower time frames. Upon a break below there, I have my final directional confirmation and I can start to look for sell positions. So as this market is now approaching this area of supply again, this is the picture that we have over here, right? I just want to see proof of supply right now. I want to see that this area indeed is valid as supply, because this can easily, cross above there and start to go higher. Some of you might have even marked this up as an accumulation, preliminary support, selling climax, secondary test in phase B, and maybe you were waiting for this to come up higher and prove to you that it's an accumulation by breaking structure. And by the way, this is why we always want to see a break of structure for accumulation and distribution. Simply waiting for that would have stopped you from taking premature buy positions and losing your money on this scenario. But now I have my area of interest. The rough area that I had marked up was an hourly candle, this final hourly push to the upside. But it's a rough area. I haven't got my point of interest just yet. I know that we have inefficiency or an imbalance up here. I know that we have had this final push to the upside where it has taken the previous highs, and indeed it's reversed quite impulsively and aggressively back down. So in that rough area, I want to see if we still have supply. So what am I waiting for right now? I'm waiting for the market to, number one, approach my level again, and number two, give me my final directional confirmation by breaking the structure of this counter trend market coming back up. So we can go ahead and identify the major low, major higher low, higher low. This is the next major higher low. And simply, I'm just waiting right now for this market to actually come and approach my point of interest. So as it's approaching that level, as it's actually come into that area that I was waiting for, I'm still not taking the trade over here. At this stage, some of you would be taking the trade, and that's okay. Some of you might be on the 1 minute or 3 minute or 5 minute time frames, and perhaps you might want to take the trade based on these type of breaks of structure. For me, I just wanted to wait a little bit more to get some more confirmation, as we did have a lot of imbalance up here. So, it did have the possibility of this pushing higher. So I just wanted to see a little bit more of a defined confirmation, I'm going to say. So, at this stage, I'm still waiting. We are in this area of supply. I just want to see proof of supply right now. So we are waiting, and I'm still waiting in these scenarios. I'm still not doing anything. I'm still not executing any trades. And boom, right over there. This is where now we have challenged this previous structure point to the downside. Again, you wouldn't have necessarily needed to wait this long. You could have indeed taken some of these structure points into account. But for me, the way that I looked at it was this was the lowest point that sponsored this entire range to the upside. So this indeed must be a level of demand down here. And if we break below this level of demand, then my sell positions are most likely confirmed. If this takes place, I can wait for a retracement and start to sell this back down. So now I have the directional confirmation. Now I know that that's an area of valid supply up there. It has indeed broken structure to the downside in my desired direction as well. So now it's time to start to look at entries. This is around the time that I want to start to look perhaps at this final move to the downside and break it down a little bit more and trying to figure out where is it more likely for this market to actually reverse and return to. Naturally, in these scenarios, I would instantly favor a deeper retracement, more of a deeper pullback, especially once it's now come down and challenged these structure points as well. The reason behind it is because I see this as supply. I see this as proof of supply or a recharge of supply, and this supply has now been proven by violating some previous zones of demand, by now taking people out of their trades. Now people have been manipulated out, which opens more positions, which opens more room for the bigger institutions to be able to sell this back down with even larger positions. So it kind of makes sense for a deeper retracement for something like this to, in a way, recharge the supply up there and have more of a strength coming back down. So in these scenarios, I will practically always favor a deeper retracement. And kind of in this picture, it was a little bit clearer, especially as we did have this trend line coming down, which meant loads of liquidity being above this trend line. So this kind of push to the upside to take the liquidity of the trend line to give us that deeper retracement. Not that it was fully confirmed, but it was a little bit more probable. This is normally where I would browse between different time frames. I wouldn't necessarily go to the lower time frames to find my point of interest. I might even go to the higher time frames to find the general area for my point of interest. And then I would start to perfect that more and more on the lower time frames. So this is a bit of a gamble, a bit of a shot in the dark for me to expect this trend line to be manipulated, but that was the analogy that I decided to kind of go based on, and that was the school of thought that I decided to follow with this specific analysis. So naturally, I'm expecting this to move higher, which means I'm probably expecting these highs to be taken for this to push higher. And on the hourly time frame right now, even if you look at the lower time frames, the points of interest above this level most definitely look a lot more attractive, again, from a factual perspective, rather than the ones at this distribution or minor distribution and below it. And the reason I'm saying this is looking at this on the hourly picture, it's a little bit difficult for me to be able to say with certainty that we have areas over here that are left unmitigated. Guaranteed, if I go to the 1 minute time frame, we might be able to find things, but probably the most attractive higher time frame level would be this institutional candle in the middle of the range, right? For this to be mitigated and for this to be taken down lower. But normally that's not a level that's going to be giving us this huge retracement back down, especially since in this case, it hasn't actually left any type of imbalance after it. It's just a random institutional candle in the middle of the range, and it kind of looks like it pulled back to it. So since I'm expecting a manipulation of the trend line, expecting this to push higher, I can probably even say it's going to push higher than there and most likely tap into these previous areas of supply. It's most definitely up there that something has taken place. It was up there that this whole move was sponsored. It was up here that we had the final push to the upside, manipulating the highs. We can see clear signs of imbalance on a lot of time frames. We can see drop-based drop formations. Again, this is an area of supply at the end of the day coming back down. So now my points of interest would be up here. I would be looking at specific points of interest somewhere up there. It was still a little bit challenging and difficult to mark up the exact specific area that I wanted to go based on, especially because the more obvious scenarios would have been taking trades based on institutional candles over here, with stop losses being at the high. And not saying these are bad scenarios, by all means, you can go ahead and take these, but I personally knew it was possible to have better risk rewards and smaller stop losses. So I decided to stay patient with this and simply let it play out. This is where I have the directional confirmation. I have the area of entry as well, because I'm expecting the trend line to be manipulated. I'm expecting for us to come back into these rough area up here that is introduced supply. We have institutional candles and imbalances and so on and so forth. And within this range, I'll get my deep retracement. And this is where I would be paying closer attention to it on the lower time frame as it comes up, because you guessed it, as this will approach this level, most definitely on the lower time frames, it will start to create yet another trend over there. And what if I can see that and take the trade based on a break of the structure of that 1 minute trend, for example, the same thing that a lot of people could have done over here. I've just waited a little bit more. I'll do them again, probably would have better risk rewards and more confirmed trades. So we wait. We wait and we wait. We have our alerts in place. We'll let this play out and do its thing. Once this took place, it kind of made it a little bit more confirmed in the sense that, you know, it's now creating trendline liquidity to the downside as well. When I saw these first two touches, I was like, okay, you know, this is interesting, because now this first trend line has been manipulated. We're good. So it did exactly what we wanted it to do, you know, reached above that level and so on and so forth. But interestingly, it's now created trendline liquidity to the downside. So most definitely, this would be scenarios that people would be waiting for. So not 100% confirmed, but it's likely for this to break below this trend line and come lower. Now I have no need of being on the hourly time frame anymore. I've actually already analyzed 15-minute time frame as well. We looked at the 15-minute structure when this market was dropping over here. So I'm mostly now attracted to the 5-minute, 3-minute, 1-minute time frames. But I'm just going to play this a little bit more so it comes to our level before I visit those. There we go. Before we do that, and we can keep it there. So now I want to kind of follow through with this analysis on the lower time frames, such as 5-minute, 3-minute, 1-minute. I've already done the relative higher time frame analysis. We now have everything that we need. We have got that area of supply. We've got proof of supply over here. We pulled back to manipulate the trend line, to fill in whatever needed to be filled in over here and mitigate whatever needed to be mitigated over there. So all of that is done. I now want to pay attention to the final details to then be able to go ahead and execute my trade. And the final detail that was observed was this. This move back down over here was very interesting to see. So once we approached this level again, and this started to turn and started to be slow, this was around the times that I started to look for entries, but it wasn't clean enough just yet. It wasn't something that was grabbing my attention a lot. And once this final push to the upside took place, it kind of made sense. You know, we've now yet again manipulated the previous highs, and on the 1-minute time frame, we can indeed look at the structure points within this range to the upside as well. And the way I personally looked at this is on the 1 minute time frame, on the 1 minute trend, this low seemed to be significant. And the reason I say that is that was the final little pullback that we received, the final little consolidation range before this moved up and created the final high over there. To me, that means that we introduced the final bit of demand down here. This market should have remained above these levels of reaccumulation over here as well, if it was planning to go any higher. And the fact that it has now broken below there, I can now see this as a minor break of structure to the downside, which in a way is confirming our area of supply yet again. Now I have absolutely everything. Now the trade is ready. Now we have yet again this final confirmation as well. I did the exact same thing, by the way, the same little, let's say, pullback that we had over here. We are trading based on a break of that structure to confirm that directional bias yet again. We don't need to see all of these confirmations, but I'm going through this slowly and step by step, so you actually kind of get to see my thought process as I'm going through it as well. And this is where we can have a look at the final screenshot taken on March the 18th. At just before New York opened. So this is London time. This is 11 a.m. London time. So we're talking literally just under 48 hours ago. And this is that 1 minute picture that we just saw. That was the break of that minor structure point to the downside that was observed. And as you can see, indeed, we pulled back up and the rough entry area was 1.39931 with stop loss being at 1.39998. And for those of you that might now be wondering as to why I marked up that specific level up there and why, for example, I wasn't interested, let's say, in the imbalances down here or this bigger institutional candle in the middle of this range and so on and so forth, one simple reason: where was the break of structure sponsored by? Now, this is something that I will have to go into a lot more information about it later, but generally speaking, especially looking at this on the 15-second time frame, it was in a way this redistribution that sponsored this break of minor structure point to the downside. So this entire move from up there, and especially this redistribution, were the reasons why this market adapted to this bearish move back down, which meant that can prove as a future area of supply up here. Previously, we had introduced supply up there. So we can indeed be doing that again at this drop-based drop formation at that area of supply. Now, I don't normally want to, take my trades at the bottom and put my stops at the top. Sometimes we do that with institutional candles, but within this range, it doesn't really make sense to do that, if that makes sense. So I would just want to see the market in that level. I'm not waiting for any more confirmations. Once it reaches my level, once it reaches that kind of desired area, I would go ahead and execute the trade. I'll go ahead and pull the trigger there and then. And it's just a matter of where I would want to place my stop loss. This is where mostly the second base time frames kind of came into place. And I personally decided to have my stop loss right at this structural high on the 15-second time frame. And the reason I put it over there, some of you again may be wondering, why did you have your stop loss here? Why not up here, or maybe a few pips above, and so on and so forth? When you're looking at low stop losses and high risk to rewards, the difference between 2 or 3 pips can literally be the difference between you catching a 1 to 20 risk to rewards and you catching a 1 to 50, 1 to 60, 1 to 80 risk to reward. So not that I always want to have the smallest stop loss, not that I always want to have the sniper entry, but I always want to perfect my trade to the best of my abilities, as long as it's not based on emotions, as long as it's based on facts. And the fact that we have over here is this is my fractal structure point. That's high, low, lower, low, in a way, lower, high, lower, low, so on and so forth. So if I am to take the trade based on this structure point, based on this lower high, based on this redistribution of the price, then my trades are probably going to be invalidated if this market crosses anywhere above that structural high, which means I don't necessarily need my stop loss up there. It doesn't make that big a difference in this specific case, but you can imagine if you're looking at different pairs, different time frames, that little difference can literally be 5 pips, 10 pips, 20 pips even, and that makes a big difference in your stop losses. Now, funnily enough, I'm in these trades, I've executed them, but I'm still thinking that this is a hedge scenario. So remember, I still want to buy this. I still want to be on the bullish side of it. So I've sold it up there to then be able to buy it later on. So now I want to find areas of take profit or areas of significance for me to manage my trade properly. I instantly know that I'm targeting below that trend line. So practically none of the stuff that happens before that I care about. None of these stuff is going to throw me off. I would not, and I did not actually see this as a break of structure to the upside. That was a clear manipulation. That was a clear, in a way, sign to give us re-entry opportunities. I'm not going to go into detail about these specific re-entries over here. This video would be way too long if I want to cover this as well. But generally speaking, I know I'm targeting below the trend lines. That's the first thing on my mind. First, we got to take the trend line. We got to manipulate the trend line. So practically, I would start to look at this around here. Obviously, before that, we kept an eye on it to, in a way, take the other trades. But I would manage these trades practically once we've taken the trend line. That's where I'm targeting. That's where I know this market is likely to go. And the risk I'm taking is based on that. So if I'm wrong, I'm willing to lose my money because that's a risk I'm willing to take. So instantly, I know I'm targeting below the trend lines, and I can see that we do have a big amount of imbalance and unmitigated institutional candles down there. So this would make that entire range a point of interest for the buy side. And it looked good. Why? Simply because that would have been a manipulation of the trend line. That would have been a rejection of that point of interest. You know, it's quite nice to see that. So I was getting ready to look for buy scenarios along that range, where as we started to approach this level more and more, I was unsure about this trade, and it didn't really result in it being a trade scenario that I wanted to take. It approached that level quite impulsively. It didn't really give us any signs of lower time frame reversal. So there was no need for me to, in a way, want to take partials on these sell positions. There was no need for me to want to look to buy this. I decided to remain in these sell positions and keep them open. I'm not sure exactly, but I think this is now floating at something like a 1 to 23, and this is at 1 to 17, which is phenomenal within a space of a 48 hours on an intraday basis. And these are trades that I still have open. I have actually kept just under 100% volume over the weekend. So in a way, stop losses are covered. All of these stuff, a small portion has been closed, but majority, over 95% of all of these positions are actually still open, still running. And I'm keeping these open over this weekend as I'm talking right now, because again, I know the risk that I'm taking. I know exactly kind of what I'm expecting. I also know that this level that the market is hovering around right now can indeed qualify as a price reversal zone. That could be, again, an imbalance, an institutional candle, generally a point of interest. So I know the risk of the kind of new week starting with a very bullish GBPUSD. Knowing these stuff, I still decided to keep this open over the weekend, because worst case scenario is this market reversing without me and taking me out at two, not break even, but two small profit trades, which is something that I'm comfortable with. But the other scenario is still what I'm going to be chasing throughout next week and the week after, in the sense that I plan to keep these sell positions open until proven otherwise. If I can get in some buy positions with GBPUSD, simply because the structure is on our side, I would be following that. But something that's kind of very obvious to me as well is this move that we had down here, which manipulated these lows, created that imbalance that was never closed, and sponsored this entire range to the upside. That area as an area of demand is extremely attractive. Hence why I have put the final take profits just above this level, just before we approach it. I do have a hunch that we can be approaching this level, especially before having the next leg to the upside. It kind of makes sense for us to approach this level. That's why I want to keep my sell positions open. But as of right now, you know that I wouldn't necessarily be too interested in the points of interest back here. I would just want to keep an eye on them, exactly what I'm doing right now. More so, I'm waiting for the structure to prove me wrong. So once this bearish structure starts to turn around and turn bullish, that's around the time that I'll be looking for entries, as long as I have the full confirmations followed with it. Now, I don't want you necessarily to watch my videos and adapt the exact trading style that I have right now, because the trading style that everyone adapts depends on a lot of different things. Mostly it depends on your lifestyle and on your other commitments as well. So you don't have to duplicate exactly what I do, but take elements of what we have spoken about to hopefully little by little be able to apply to your analysis, and little by little be able to see better results. Don't overcomplicate it. Don't overanalyze it for yourself. Again, know that we always speak about patience, so be patient, both in your learning and in your earning, especially when it comes to this style of analysis. Now you see how much I wait before I take the trade, but the trades that are being executed are successful ones. They're going in our direction. They're following exactly what we wanted to do, which makes the wait worth it, which makes it even worth it to not have to necessarily execute a trade in the same week or multiple trades within the same week. So patience, patience, patience. Also, when it comes to hedging, please stay away from hedging, stay away from what I just spoke about, unless you have experience in the financial markets. It's not something that I recommend beginners, beginner traders or beginner smart money and Wyckoff traders to get into. Please give yourself more time with the idea of hedging. There's so many things you have to take into account, especially since it's a counter trend scenario, since you're going against a major trend. But little by little, start forward testing it and start learning it. Remember what we spoke about over-analyzing it there. If you feel like you're analyzing it way too much, simply move on to the next currency pair and use alerts to stop yourself from looking at the charts 24/7. Do you think I'm going to be monitoring this pair until it reverses from all the way down here up there? No, of course not. I'm going to be setting an alert up there, and whenever my alert goes off, I open my laptop, I check it. If need be, I'll monitor it. If not, I'll set another alert until it comes closer to my point of interest. use TradingView alerts or whatever alerts that you're using in your favor. The TradingView alerts can help you so much with trading psychology and trade management. And the final thing I'll add in regards to this before I speak about the next video and exactly what I meant at the start of the video is that it makes sense to have access to a community of traders that are trading the same way as you. It doesn't make sense to be in a community of beginner traders that everyone is trying to learn the same thing, but it makes sense to be in a community of traders where you have people around you who are trying to learn with you, but you also have professionals next to you that can answer your questions, that can hold your hand in the journey, that can help you. We are talking about the biggest financial market in the world. So please understand that it's a little bit more complicated than you think. You need that community of people around you. You need to be able to have access to a wave, to an ocean of traders that are thinking the same way, that have the same goals, that will be keeping you on your journey. And that's indeed the catalyst for the success of a lot of people that we work with as well, the community around them, the people around them that will help them in this journey. But this now brings us to a conclusion of market structure part 2. As explained in the previous video, I wanted to help you to understand where we are going to be reversing within these retracements. And now hopefully you have an answer to that. Hopefully you are a little bit more clear.
All righty. He said a mouthful, man. I get hype every time I watch this video now. I remember the first time that I watched the video and how freaking lost I was. There's a lot of information in this video, this particular video. He hit on a lot of things that Felicia, you probably, hopefully, this video struck a chord with you, Elfie, you too. From the WhatsApp days, a lot of things that he hit on in this video, we talk about or have talked about on a individual basis, right? I purposely don't give you guys too much information. Yeah, this guy's name is Pips of Persia on YouTube. Like he has been instrumental in my personal trade journey. Just the way he breaks things down. I can relate. I can understand. I think he breaks it down very clearly. He's who I leaned on when I started learning Wyckoff, and this market structure series is very impressive because he doesn't leave anything out, right? He talks about breaks of structure. Those are very important. He doesn't tie in order blocks the way that I use them or I would like to see them. But, that's not his job. He trades the way he trades. He educates the way he educates. And it's up to us to come in and do the rest. So, those of you who trade with me or who know how I trade, when I look at the order block, these are the order blocks that I choose to focus on, right? Not this style of order block over here, but this style of order block. This is a bearish order block. It breaks structure, all right? It breaks the low of this green candle, right? To the downside, which is a bearish move, right? If you drop down to a lower time frame, there are several candles contained in this green candle. If you want to look at the 4-hour candle, there's 6 4-hour candles in this one green candle. Then there are 6 4-hour candles in this red candle. So in this 2-candle formation, there are actually 12 4-hour candles. And what you will see is you'll see the market go up, and then you'll see it break structure to the downside, letting you know that, hey, we're about to go down. Then it'll push down, it'll retest this area, and then it drops. All of this, everything that he talked about can be seen in these order blocks, the break of structure, right? And if you keep dropping down timeframes, you can start viewing it on the 15-second or 15-minute. He spoke of being fractal. I used to use that term a lot. You know, what you see on the higher time frames, you'll eventually see on the lower time frames, right? And sometimes vice versa. When you want to, or when you're biased for a directional move, right? Like if I see this bearish order block, right? And then this price is pushing up. If I drop down to the 15-minute time frame and see a break of structure, price going back down, I already know it's already confirmed that the market is going to sell. I'm just waiting for that break of structure on the lower time frame for my entry, right? The same way, once price gets into this order block, I'm just waiting for the break of structure for the price to move my direction. And that's why it's important to be able to drop down in your time frames to find an entry criteria that matches what you're looking for. All right, that serves as confirmation for what you are looking for. Does that make sense? I want to look at a couple of pairs, right? And, you know, and just, you know, very high level, right? Just to kind of touch on some things that he talked about. All right, this is USDCAD, and this is USDCAD. This is a weekly chart. This is a chart that most traders never even see, right? They don't look this far out. But if you look at what price has done, right? You can see that structure is followed, right? Price is pushing down. You get this huge retracement that breaks structure. Price pulls back. To this zone, right? It pulls right back. You could have taken the trade and it pushed higher. Where do you target? You target these highs. That would have been your first target. It pushed higher than this, right? Once price pushes higher than this, the next target is this high. It pushed higher than that, right? Then your next target would have been this high. It never made it. But what it did do is create relative equal highs, right? Big picture. If you look at the big picture and you run the fib, you know, from this low to these highs, all you got was a 50% retracement, right? And if you look at where price is right now, if you look at from this weekly time frame, you get higher, basically higher lows right here, right? These are relative equal lows. This is actually a swing low. You got a higher low, a lower low, and a higher low. So if you notice on my chart, I have this area right here. There's two green lines. This area marked up for a POI for a pullback. So before the market even got here, I'm anticipating that this market is pulling back here, and this is where I'm going to look for a push up. Now, if you think about the events of the news, oil prices are shooting up. So it's pushing the USD CAD down, right? As soon as the USD CAD gets to our area of interest, we're about to raise interest rates. Oh, shucks. If we raise interest rates, this price should turn and push up, right? Especially if we raise it to, 50 cents instead of the 25 points. So if you think about the way that news sets up, isn't it interesting that your chart kind of plays out around the news events? Isn't it interesting that your areas of emphasis are right around the news events that can change the flow of the market? you know, the war happened. So a lot of times, you know, if you look at the market around wars around like 9/11, you know, maybe you'll get something weird that happens that's totally against the grain. But for the most part, your charts are going to set up around what's happening, right? So if you're just a technical trader, you can still make money. I mean, you might not make money on the dime, like you might not time this perfectly, right? But you have your areas of interest, right? And you're watching to see if price is respecting your levels, right? So don't be fooled. You see how this, you got from this low to the impulse, you get a pullback, then you get a lower high and a deeper pullback. It still didn't violate this low. So some people would say, oh, well, the market is going to push down because it came down this high. This is just a complex pullback, right? You guys may not know what that means, but if you watch enough videos, people will talk about these complex pullback, right? Don't be fooled by the window dressing. This complex pullback is window dressing for market makers. What you're looking at as a trader is your major structural points, right? And for a while there, we used to mark these up. If you remember, Felicia, maybe Elfie, you might remember as well. We used to mark these major structural points up. Maybe you didn't do it on a weekly, maybe you did it on a daily. But when you mark your structural points on your chart and you see price coming to those areas, then you're comfortable, right? And you're confident that, hey, man, this market is still in an uptrend, right? It still hasn't violated my major structural points. Now, if this market pushes down and violates this low, now we can have a different conversation. We wait for a pullback and we find the area that sponsored this break of structure. And that's our zone that we will focus on to take a trade down. Okay. Now, again, we're on the daily, we're on the higher time frames. If you notice, he was trading, he was looking at an hourly time frame, and then he would drop down to the 15-minute or the 15-second or the 2-minute or whatever. You can trade your time frames, the time frames of your choosing. The thing that you have to understand as a trader is you take your directional bias from the higher time frame, and then you drop down for your entries on a lower time frame, right? With structure being your key. All right? With structure being your key. I think it's very important for newer traders to maybe mark your major highs and lows, right? Because if you mark this up like this, then on the 4-hour time frame, you're not getting food. If you're just looking at the 4-hour time frame, you don't know what way the trend is going, because this, you might have, this is a high, lower, low, right? Then the market comes back and breaks this high, right? And you're like, all right, we're going higher. And then it falls and breaks these lows. Well, if you're up here on this time frame, then you understand this is just a complex pullback, right? This is the market maker making money off people who never look at these higher time frames. All the market did right here is manipulate the high and then dropped, right? Took out all these lows. Everybody who was long took them out. Then it moved right past the highs. But if you're on the higher time frame, you're not fooled. You understand that we're in an uptrend and you're waiting for the pullback to come, right? And however you want to do your pullbacks, I think, you know, if you guys listen to my brother, he likes to use the 78%, right? If this market doesn't pull back to the 78%, he's not taking a trade. That's fine if you want to be like that as a trader. you'll take less trades, but you'll be very successful, right? In the trades that you do take, because they'll reach your 75% pullback or your 78% pullback, and then you go your direction. ICT is another guy that only takes a 75% pullback. For me, this pullback is perfect, you know, but you have to, this is an example to where you can create rules in your trading plan that will help you become successful, right? It's another pullback about the same level as this first pullback, and the market goes up. If you look at this final one, the one that I've been waiting on, the market is right here at the 78%, right? And I think the wick on that candle down there touches the 78%. So I am looking for this market to push up. Now, that doesn't mean that it's just going to violate this order block, right? Think about this. What's wrong with it pushing up to this order block, double bottom, and then pushing higher, right? There's nothing that says the market can't do this. Or if you remember your retail concepts, maybe you get the inverse head and shoulder right here, right? Shoulder, head, shoulder, it comes back and makes a higher low and then pushes higher. All of these scenarios, right, are possible. There's a possibility. It's a possibility of a hard double bottom right here. Or you get the inverse head and shoulder move. But at any rate, once you get this break of structure, you want the price to come revisit that break before it pushes higher. Yeah, exactly. You can get a swing low, but that's the same thing as the inverse head and shoulder, because this is a low, this is a lower low, and this is a higher low, which creates the swing low. And that should serve, you know, pretty much as your confirmation. But if you paid attention to the video, a lot of what he said is just going to reaffirm things that you've learned, you know, since you've been a part of this community, right? There is nothing new, you know. Maybe we talk a bit different, or we use different terminology, or we put a different spin on it. But the bottom line is, if you wait for breaks of structure and then retest of those breaks, your success rate as a trader goes way up, right? And it doesn't matter which time frame you're trading. If you're trading the 15-minute time frame and you're waiting on breaks of structure, right? Once this price breaks structure, you want it to pull back. Then you can take this trade and go up, right? The difference in trading these lower time frames is maybe you're looking for it to pull back here and it drops below your area, right? Because what you missed on a higher time frame was that the area that sponsored the break was actually way over here somewhere, right? And in USDCAD, when you look at it on a very high level, the supply and demand zones were established way back in the past, right? So if you look across here, your zone is right here, man. This is your zone that broke structure. Price came back, it touched your zone, price got out of there. It came back, it touched your zone, price got out of there. This is your valid zone right here. Right? This zone has been active since 2015, you know? So you always want to take into consideration your higher timeframes, because it's so powerful that you could mark a zone up and accidentally your trade, you'll see price pushing towards your zone that you know is active. So if you understand how price moves and it's moving to the zone and you're going to get a reaction, you could have caught this trade. And this trade would have been worth a bunch of money in terms of pips, you know, because if you just took this trade from this zone, that's 789 pips, right? It didn't get it all at once, but this is how you can get into a swing trade and hold that trade with confidence, because you got the reaction from the zone, you got a pullback that was higher, it gave you a higher low, so you know you can hold on to this trade. Not only can you hold on to the trade, you can add position because it's just going to go higher, right? Then you got another higher low. So if somebody was paying attention and they took the trade from the zone, they probably added here, then they added here, right? And now it's pulling back again. They might have added on that bounce that I just showed you where the wick hit the 78.6. So somebody had 1, 2, 3, and they're working on their fourth entry for a trade that maybe they cash out, you know, for Christmas, or they cash out next year. Who knows, you know, like how high this will go. But this is how you take a small thing and you turn it into a major win just off market structure, just because you understand how the market is moving. Do I have any questions over anything that we covered this morning? I know the class was lengthy. I didn't start the recording. You know, I'm old, so I didn't start it at the beginning of the video. But the video that we watched was by Pips of Persia, and it's market structure, advanced market structure, part 2. You know, I encourage you guys to start doing research on your own. Okay. I watched all these videos back to back to back to back. You know, I'm not saying that you have to do that, but trading is going to require you to go out on your own and do some studying. It's going to require you to dedicate some time, you know, to honing in on your craft and on your skill set, because the more information you have as a trader, the more powerful you become, right? And you know, it's funny that that he was saying that you need a community of traders. You know, I totally agree, and that's why I created my own. You know, that's what attracted me to Ruby's course at first. You know, we could help educate each other, we could talk freely, and then all of a sudden we were kind of shut down. We couldn't share information, and you know, that's kind of like the U.S. government. You know, they don't educate people; they keep them financially dumb, and we all go out and get jobs and once you get a job, you can never have the life that you truly desire, right? You'll never have time freedom, and you know, probably 95 or percent or higher will never have financial freedom, right? Now, financial freedom requires us to educate ourselves on what to do with money, because even if you're a trader and you're making a bunch of money, if you don't know what to do with it, you won't have financial freedom. You'll just blow it all. But that's why you have a community, right? Because you have people who are currently doing what it is that you want to do. And I'll be the first to tell you that this is not rocket science. It requires, you know, I mean, if you can speak English, you can trade, right? If you can drive, you can trade. It does require a level of discipline that is uncommon to most people, right? I was going to say most Americans, but it's probably uncommon to most people. So that part of it, you're going to have to conquer. You have to conquer yourself. If you can't master yourself, you'll never become the trader that you could be. But if you're capable of mastering yourself, if you've ever been successful on a diet, if you've ever been successful stopping an addiction, smoking, you have a shoe up because you know what it takes. If you ever graduated basic training, if you ever adhere to a strict rule-based system, if you ever practiced monogamy, if you ever practice, religion, kind of like the Muslims do, or Jehovah's Witnesses, or whatever. If you're capable of extreme discipline, you're capable of being a great trader, because it just requires extreme discipline, right? Trade what you see. Trade the setups that you see. Take the trade to the level that you know you can take it, right? All of these things, you just keep adding to your toolkit, and you become a highly effective, highly successful trader. Do you have any questions over anything that we've covered?
I have a question
Yes, ma'am.
regarding supply and demand.
Uh-huh.
'Cause I never really used that for those terms. Those are basically like the major order blocks where everything kind of bounces off of, can you explain it with different words?
So it means a lot of different things to a lot of different people. All right, but the best way for me to describe this, right, is if you look at this chart on the weekly, price came from this level, it impulse moved to this level, right? Everything you see from here is just a manipulation, right, of the highs. This is price distributing, right, to push down lower, right? But for all intents and purposes, the market moved from this line to here. Then you got the pullback, right? So when it pulled back, it accumulated, right? It accumulated orders to push higher. So it moved from this low, right, to this high. So right here is where it accumulated the orders to push the market from this level to this level. So this is going to be your supply zone, right? Now, had the market never pulled back here and it pulled all the way back here, this would be your supply level, right? And maybe if the market ever pushes down, it will respond. And it's not even a maybe, right? The market will respond at this level too. Once price comes down, right? If price is coming down and it hits this area, you're going to get a reaction, because tons of orders were put in right here to push the market to this level. Then it pulled back. Tons of orders were placed here to push the market to this level. Then it pulled back. When it hit this level, it reacted to these orders. Went way up here. Came back, it touched this level again, it reacted again, and it pushed up. So when you talk about supply and demand, right? This is your supply zone. And the market has reacted here as your demand level, right? So if you have swing traders, these levels are marked up for them, right? They want to, or they want to watch for the buys when it gets here, and they want to look for the sales when it gets here.
So supply is on the bottom and demand is on the top. It's kind of like support and resistance, or
yeah,
I don't know. Yes, okay.
Yeah. It's just like support and resistance.
Okay, because I was feeling like I'm stuck with that.
Well, listen, I don't think you have to be caught up in the terminology, right? Just like rally-based rally. Rally-based rally or drop-based drop is a bullish order block or a bearish order block. That's all that is. If you ever look at a range, right?
Yes.
Rally, base.
I'm sorry.
It's cool. So you got rally, base, rally. You see this red candle in between? That's the base. Rally, base, rally. Rally, base, rally. Still order blocks. It's order blocks. It's different terminology, it's different terminology, but it's the same thing, right? So when the Pips of Persia talks about base, he might talk about this entire 1, 2, 3, 4, 5. This entire 5 weeks is a base. Then the market pushes higher. Here's another base. This base happened to be one down week and then the up week, right? So I don't want you to get caught up in the term. Don't let the terminology fool you, right? Call it what you want to call it, right? But I just want you to have an understanding of what you're seeing, right? And in every one of these scenarios, you got the market pushes up. Ruby would tell you this, that it consolidates, then it pushes higher, it consolidates, it pushes higher. Who gives a crap of what you call it, right? All you're getting is the market pushing up. It's accumulating orders, right? We call this an accumulation. We're manipulating these highs and lows, right? And if you look, these lows are being manipulated, and then it drops, and then there's a spring, and the market pushes up. Then it comes back and it manipulates the low again, and then it pushes up, right? So I don't care how you look at it. I want you to understand what's going on, right? The important thing is you understand what you're seeing. And you understand that, hey, in the grand scheme of things, this is my low. If price doesn't violate this low, right? And it creates a higher low, the market is going higher, right? And when it pulls back, if it creates a higher low, the market is going higher. Call it whatever the heck you want to call it. Just don't call it a sell. You know what I'm saying? If you understand this as a trader, this is all you need to make money. Like the market cannot sell until it breaks this point, right? It can retrace to this level, but until it breaks this level, we can't say that the market is pushing down. Like you can't look for the market to push down past this level. You can look at it, retrace to this level, and then push up. But until it breaks this major low right here, that's basically what Pips of Persia was saying. You can't sell that. You can't take a sell from here. You can't anticipate that the market is going to sell just because you got this huge push down. You can't say, okay, well, it's going to keep selling. No. You have to look at this area, you know, as big brother. You got to respect it until it gets disrespected. You can't speculate that it's going to push down. You have to watch for it to do that. And that's why he was telling you that you identify these areas and you watch for breaks of structure. If you understand that, you will be a highly successful trader.
Okay, I think I get it. Just don't worry about the terms because
And look, here's the thing.
it's what I see anyways.
Right, but I think that if you're interested in learning those terms, go to YouTube, type in supply and demand, and they'll educate the hell out of you, you know? I personally don't look at it like that, right? Supply and demand zones. I understand that they exist, you know, kind of like imbalances when I trade currency pairs. I'm not overly concerned about imbalances. If I trade a currency pair from order block to order block, it's gonna account for those imbalances, right? So if you choose to focus on those things, that's a personal choice, right? But basically all we're saying is the same thing. It's kind of like, you know, Felicia was asking me about chalk last week, and we're going to get to that eventually, Felicia. But chalk is change of character, right? You can split hairs over change of character, but at the end of the day, it's highs and lows being broken, right? And if you understand how to look at it, right, then it gives you an advantage to be able to take a trade, you know, whenever you see a chop, right? So if you look at it right here, the market pushes down and it breaks structure, right, to the downside, and immediately it breaks structure back to the upside. That's called chalk. That's what chalk is. The market starts here, breaks structure to the downside, immediately breaks structure back to the upside. Which way is the market going? It's going up. But who gives a crap about chalk if you understand market structure, right? Because you're getting higher highs and higher lows, right? These lows haven't been broken. So whether you have chalk or not, market is going up until these lows are getting broken. But if you understand chalk, what people will tell you is this gives you an advantage because the market starts here, it breaks the low, it breaks high. And all you have to do is wait for it to push down into the area, right? The area that sponsored that break. And guess where price is, right? Where the area sponsored that break. However you want to look at that, right? Whatever terminology you want to use it, you know, but you have to trust what you see. And a lot of people, you know, like a lot of traders probably in this class aren't comfortable with taking this trade as a buy, right? You want to see further confirmation. On the lower time frames, you have your confirmation. Right? On the lower time frame, price broke up. It broke this level. Maybe you want to wait for the hour to break, the hour time frame to break structure, right? On the hour, you broke structure. Broke structure. Then you immediately broke structure to the upside. Are your order blocks bullish? Bullish order block, bullish order block, right? So you're getting the moves, but the problem is with new people is you don't anticipate this. You're just kind of reacting to what you see. You're not anticipating this move. And what we want to do here, you know, with this course is we want us to be able to anticipate these moves. Like we want you to expect the market to give you a reaction at this. We want you to be able to come to the charts and say, hey man, this is where I'm going to get my pullback or whatever. Yes, ma'am.
Can you remove the fib but leave those structure points? I just want to see how like they show up on the like what price is doing on the lower time frames in reference to like those lines. I mean, they may not be able to show on the screen. I just want to see if they can, if they're able to be seen. No, like those longer, if you go back to the weekly or daily chart that you were on.
You talking about the black lines?
Yeah, those thicker black lines. I just want to see what price is doing or what it looks like on a lower time frame, since those are the structure points from the higher.
All right, let me move all this stuff out of the way. Wyckoff.
Okay, I see it. Okay.
And here's the what you can take away. a lot of people like will look at this and say, well, how do you know what direction this is going? This could be a distribution, right? You can get an up thrust and it can start pushing down, right? I mean, you can, that's valid, right?
Mhm.
This broke structure to the bottom side, right? You can say, I mean, that's all valid, right? Would you agree?
Yes.
I would agree too until you take it up a time frame, right? When you take this up a time frame, now what does it look like on a daily? Whenever we wick past the lows, what does that mean?
On half. We're buying.
Yeah, it's a concept, right? The concept is when you run that liquidity, you're pushing up. So let's say you miss that initial move. Where are you going to enter?
The next pullback.
But what's the pullback? What does the ICT say?
78%.
78%.
Where's the pullback?
Right on the money.
So this is what I'm telling you, man. Like these concepts aren't, I don't make this stuff up, right? Like they're out there and people give you that information for free. All you have to do is look. If you saw this wick, I mean, it's great to hop in on this trade and get this initial move. But this is where all the money is, man, right? It came right back to where the concept said it was going to come back. And you're not getting fooled because you're stuck on a 4-hour time frame. Because you're capable of using multiple time frames to analyze your positions. And that's the importance of doing top-down analysis. That's the importance of using all of this information, right? That's the importance of being able to go into this weekly chart and say, okay, I'm in an uptrend, right? If you understood that you're in an uptrend, you're anticipating that the price is going to give you a higher low, right? Maybe you drew out on, maybe you had a fib once it started pulling back and you drew your points out on your fib. Say, okay, I expect it to come back to whatever level, right? So if you're here and the market starts pulling back, maybe you come on your fib and say, okay, I'm not taking a trade until the market hits this level. And let me change the color. There are 1,000 ways to get paid as a trader, right? So you see the market hit your entry right here. A couple of days later, it wicked past it, but it pushed right up. That's not any, it's just going from this low to this high. I'm not entering a trade until it is 78%. Boom, it hit your 78%. Now your target, if you just use that fib, your target could have been the 627, the negative 627, right? Like these moves are here for everybody to see and they're in plain sight. The question I have for you is, do you trust your own analysis? Like, are you waiting for me to say, hey man, this is going to buy to this level? And if you are, why? Like when you already know the information, you know the concept, you can look at the market structure and you can tell me which direction it's going. You know, don't be afraid to be wrong. I mean, most of you guys are trading with a demo account. The least you can do is test that sucker out.
And that 78% you just talked about, that is an order block, correct? On a weekly.
Well, let me see. I don't know. I don't know that I saw. I didn't even look for an order block.
I think it is.
You mean right here?
Yeah.
Maybe on a lower time frame. It's not an order block.
No, right. No, right there. Go back to the weekly.
She's talking about with the wick, right, Kim?
Yeah, from the wicks
Oh,
with the wick. Yeah.
yeah. This is an order block, but just measuring from wick to wick, this impulse
Mhm.
from wick to wick, your pullback, if you're only going to enter the trade at 78%, that's part of your rule-based system. Once it pulls back to your 78%, you got the green light. It pulls back to your 78%, gives you an entry. The next day you're in drawdown a little bit, but just for a little bit, because it just wicked down there, and then it impulses right back up.
So Todd, if you got in on this entry, right, and this is, unless I missed it and I wasn't paying attention. So we know it pulled back to the 78% zone, and this is where we're going to get in. So we're going to go down to a smaller time frame to find our order block, or simply because it pulled.
I don't care about the order block. I'm
That's
just,
what I was going to say. So since it,
yeah, go ahead.
no, I was just going to say, because we know it hit our 78% zone, so we don't need any more confirmations, and we could just get in and ride it up.
Well, you have confirmation.
I mean, I'm just saying another confirmation.
So what is your confirmation? Give me your confirmation on this trade that we just talked about.
No, I know it pulled back to the 78% zone. I know that's where we're supposed to get in.
Okay, but what's your confirmation? Just because a trade pulls back 78%, what if it pulls back 100? What is your confirmation on this particular trade?
The higher low.
There you go. Market structure. Market structure is your confirmation. So what other confirmation do you need?
None.
I would argue that you have what you need to take the trade. Where the question is, where do you take the trade to? There are equal highs here. If you're just using the fib, which I wouldn't just use the fib.
For me, I would go where the liquidity is. That's where I would put my take profit.
That's where I would go to. I would take these highs first, but this would have almost went to the -27 already on that first impulse, right? I think it'll eventually go to that -27, but most people will tell you that you can trade this to this -27 right here. And I'm sure we'll get it, right? Like all we did was impulse up here, we pulled back. So this next push will probably take us to this -27. But, there are so many different, I don't want to confuse you guys, but there are so many different ways to trade, and to find your footing as a trader. There are so many different confluences that you already know that you just don't think about. Maybe if I'm not there, right? Order blocks are great, right? You're trading order blocks, which is awesome. But you combine your order blocks with your market structure, right? That's something special. If you think about this, on some level, this is an order block. Right?
Mm-hmm.
This would be a red candle. This would be a green candle. This is a weekly, maybe, let me see, 1, 2, maybe on the monthly, this is the order block, and then you get a tap in right here. This just tapped into the order block. That's all that's doing right now. You see that?
Yes.
You got the red candle, the green candle to break structure to the upside. Now price is coming back, tapping into the order block, right? Before higher. That's how you should view this break of structure. Because if you go to the trades that we normally take on the daily or whatever, right? if you break this down on the hour chart, it's going to look the same way. You're going to have a green up move, a few candles going up, and then you're going to have red candles that break structure to the downside. This next candle taps in, right?
Mm-hmm.
And then it pushes down. It's all the same thing. We call it, something different if the candles are together. This is an order block. Well, it is an order block, but if you go to a different time frame, it's a series of green candles and a series of red candles, right? A series of green candles that go up and a series of red candles that go down make an order block on some other time frame, a higher time frame than this daily. This will be one green candle, and this will be one red candle. The point is, this low was broken, right?
Yeah.
So it would look like an order block, a bearish order block. The problem with taking this trade on the bearish order block is it's against the trend, right?
Yes.
And I think we've taken a couple of those, right? And then we had to say, hey man, you still got to look at the trend before you just hop in any order block that you see, because that order block is just a retracement, to basically your trend line or your moving average, wherever this trend is going. All right, hopefully I didn't confuse you guys. I reiterate that that video is worth its weight, man, in gold. And even watching it with y'all today, I noticed a few other things that I didn't notice the first 4 or 5 times that I watched it. And it's just because I'm at a better place. I'm a better trader, than I was when I saw it the first few times. So I would encourage you guys to use these resources, man. Go tap into to these people's pages and the information that's out there, because it's going to help you as a trader. Sometimes the things that I say are going to fall on deaf ears, like you're just not going to get it. So maybe you need somebody else to explain it in a different light for you to get it, right? For it to really sink in. I'm a firm believer in going and tapping into those other sources, right? There are a lot of brilliant traders on YouTube, and they give you this information for free. The only drawback is you have to be able to piecemeal the information together to become a better trader. And that's where this community will come in to help you, because all of us don't see the same thing and we all don't trade the same way. We all have different ways of confirming our positions or our trades. So it would behoove you guys to start tapping into the resource. Like, put your trade ideas out there. Don't wait for me to put them out there. Put your own trade ideas. Let people challenge your trade idea. Like maybe it'll open your eyes to something different, that's going on. But this is how you're going to grow as a trader and start formulating your own trade ideas. Do I have any other questions before we look at some swing trading opportunities? Anyone? Bueller? All righty. So if you're not here for the swing trading,